Hello, how are you doing today? I'm Dr. Stock, and in this video, we're taking a look at what the Fed has been saying and what that exactly means for us. I wanted to provide some commentary because honestly, what they're saying drives me crazy, and I want to give some perspective on to what they're saying as far as their fight against inflation. So, in this video, you're going to see the Moo app, and using my link down in the description, you can get 15 free stocks. More on that later. So let me transition from there to this for you. So this is within the Moo app that they went and consolidated all in one place what the Fed has been saying. So they have their blackout period coming up, and so the Fed, May 2nd and May 3rd is their meeting, and we can see what Michelle Bowman has said. The Fed is focused on reducing inflation so as to support a growing economy, rising incomes, and they talk about the strong labor market, making it hard for businesses to find workers, which could increase wages, which could also keep spurring on inflation. So that's something to be aware of as far as what they're saying. And then going on to Harker, we get some additional tightening may be needed. Honestly, this is something I've talked about before. I don't think they need the additional tightening. I think that they just need to give it time. And they said so in their statement on monetary policy. They said, we don't know the full effects of what we've done. Time is going to be the thing that tells. So they already know that they don't know exactly. They're seeing some of the effects, but they won't know the full effects until time has passed. And yet they continue to tighten anyway. And I do think that we actually have some evidence that the market knows that something's broken. And that is definitely a reason to stick around in this video because, well, I think it's a pretty solid perspective. So let me move from there. It says once we reach that point, which should happen this year, I expect we will hold rates in place and let monetary policy do its work. That's been their message ongoing. And when we come down to Williams, inflation is too high. Let me see, the banking system sound resilient. Yeah, they're going to keep that message going even if it's not. So honestly, the banking system for right now, I think we're okay. We'll see if further economic decline should be something that would cause a further catalyst where we would have some reason to doubt that. Moving on from there, my message is to, I don't like the word prudent, by the way, but my message is be prudent and be prudent, be patient. My goodness, if I could only read. So it says banks are pulling back. It behooves us paying attention to the data and ask how much of our normal monetary policy job is getting done for us by the credit conditions. Okay, fine. Financial conditions not significantly tightened. And this is Christopher Waller coming out here. Inflation is far above target. We know. However, we are seeing the effects of that on the economy. It is creeping in. Inflation is coming down and moderating. So honestly, how much is the Fed in control? That's a really good question on what we have. How much tightening is really necessary on top of that? Is it okay to just pause where they're at right now and really, truly just let things ride out at the current level of tightening that they have? So I want to bring this back up, not for Moo. Like I said, I would talk about that in a moment. Instead, I want to look at the economic calendar because we're here 4:35 p.m. today. If you're watching this video on Friday, April the 21st, that hasn't come out yet. Now, mind you, with this PMI flash, not that that's what this video is about, we want to watch for that to stay above 50 if we want to see economic expansion, signs of that. Otherwise, we're looking at signs of contraction if we're below 50 like we were on this top number that we have here. So we're sort of mixed, and you can see the forecast that they have coming in a little bit softer than what we had the previous month for March. I do want to look at the CME FedWatch tool that we have, and you can see 84% chance of what's being priced in right now in the markets of another rate hike, and that's for their May meeting. So most likely that's what's going to happen, and I think the Fed is going to do it in a way that says we mean it, we're serious, and the Fed wants us to have faith in what they say, and they're going to follow through on what they say. And honestly, I think that this is that really tough scowl coming from the Fed. And I'll tell you what, the thing is about the echo chamber, and this is the thing that drives me crazy. That whole echo chamber that they have, the same message that they keep putting out and saying, it's like just a game of follow the leader. And this reminds me of a board meeting at my workplace. And this is a matter of public record. Anybody can go and listen to it, so it's not like I'm giving away any sort of internal details. But I remember years ago when my name was on the chopping block for being furloughed, the reason for furloughing teachers that year, which was just following the pandemic, when the students, and I'm telling you, this is at least nationwide, if not worldwide, the amount of emotional disruption that has happened due to the pandemic, the way that it's affected the students' emotional regulation. I mean, if you're in it, you can see it. I don't know, if you're an educator, maybe you know that story. But if you're a parent, maybe you don't see that same effects that we do at the classroom level. I've never seen anything like it. But anyway, back to the board meeting. So for that board meeting, we had one person lead it off, and he's a highly influential figure. And he says there's too many teachers and the classroom levels are too low. Right now, it comes in at an average for next year's enrollment of 16 students per classroom, and we think that's too low. We want that to be closer to 20. So they start cutting teacher positions. Mine was one of them, and I got brought back by grant money, so I never fully lost my job. So honestly, it's still up in the air whether or not I even have that job for next year. They never even told me. So that's another story for another time. But the thing is that every board member that spoke following just said, yes, I believe that 16 is too low and that 20 is a good number. And they gave no evidence to back that up. And honestly, I've done the research on class sizes, and it's mixed research, but I can tell you that on a one-to-one level, very much anecdotally from any teacher that I've ever talked to, that ability to spend more time with the children, especially the ones who are struggling the most, that is a very important thing. But that's not what this is about. This is about that echo chamber that we get where people just start saying one thing and keep on saying the same thing and just sort of following along with what they're saying because they say, hey, this is the message that we're going with. Make sure you keep that message going. And I think that that's exactly what we're seeing from the Fed. So back to the CME watch tool. I think the market knows that the Fed is probably going to break something. If we got to the June meeting, right now we're looking at a pause in June, and that could be signs that, okay, well, we have adequately tightened. Let's ride it out from now. And I think that's a very likely story. July, same thing. And then when we get to September, now we start to see a mix. That means like the Fed won't cut rates unless something breaks. So that means that the market, in my opinion, it looks like they're expecting the market to break or something to break within the economy somehow in order for these cuts to take place. So even though the Fed says, hey, we're not doing any rate cuts, yet when we go out to December, the most likely thing right now is a lower rate than what we're currently sitting at. So you can actually see that down here in the table, 475 to 500 basis points is the current. And right now, the most likely thing, if we go to that one, that's only 20% chance that we're still there according to the market. So I think the market does expect that there's some over tightening or that there is some economic instability, because otherwise I don't think that we would see those sort of breaks that we have in there. So as per Moomoo, I'm about to jump back in. By using my link down in the description, you can get 15 free stocks, and you do so just by depositing $100 or more. That $100, still your cash to trade or do whatever you want with it. You get 5 free stocks for doing that and access to free premium courses. $1,000 gets you 15 free stocks, and why not take advantage of that offer? There we go. And then there's also financial literacy, U.S. paper trading competition you can also be part of with some cash prizes, as well as access to 1 month of Bazinga Pro for free. Now, for Moomoo itself, let me pop that down and transition over here, and we'll take a look at the markets just real quick, and then we'll wrap this thing up. So when we look at the markets, let me go here, and we will go to my friend the Qs, QQQ. And we'll pop that out so that it's a little bit cleaner to look at here. You can see this run that we've been on, and we've been slightly running up, but yet what we have for the momentum is kind of slowly turning down. I think that that's going to be something that holds us down off this peak for a little while longer. Now, that doesn't mean that it's something that continues. Something that would show us that further is if we actually had a drop down where we start to come close to these lows, and then when we come back up, not be able to reach that high in momentum. And if we continue to get that sort of divergence, that can be a really strong signal that the market is about to turn. Now, I don't know that that's going to happen. We are still in bullish territory, and it's possible that we hear earnings or other economic news that really starts to ramp us back up, such as much lower inflation throughout the month of, I should say for the end of April, when we get the PCE report with the personal income and outlays, and then also looking ahead to CPI and PPI. Those are other things that can really spur us forward, besides excellent earnings and strong forecasts coming out, especially for big tech. I'll make a video on that on another time. We have a little bit of time before that comes out. So I got to say that what we saw back here in August, I think it's possible that we do reach that peak again before we get any sort of significant weakness. It is also possible that we never get there. And so that's limbo that you hear me say. It's like, well, what is it? What is it? If I knew, we wouldn't see that barcode. And the market doesn't even know what exactly is going to happen next. That's something that right now is highly debated. So we get the bears and the bulls not being able to move each other in either direction. So we get a sideways trade, and that's why you're starting to see a drop in momentum here. So let's go over to the SPY. All right, and when we look at the SPY, you can see that we actually leveled off. We hit this previous high that we had here, and it, if we failed to break it, if we come back down, especially if we make it all the way down to that 378 level, that, first of all, that's a huge drop from where we currently sit. So people are already going to be unhappy about that sort of market drop. But if we do come back down to about 378, maybe down to 374, somewhere in there, big drop, we can get that double top formation, and that's something to watch out for. Right now, we sort of have a little bit of a double bottom going on. That's good. But what we want to see is this break above if we're going to continue to have any sort of a bullish momentum moving on there. But it's going to take strong reports that say that inflation really is transitory, that it's on its way out, that it's continuing to settle. We need that continuation, and that's going to be something that helps the markets, and also Q1 earnings with forward guidance. So, and it's okay if Q1 earnings is a little bit murky for big tech, but it is their outlook for the rest of 2023 that's going to be absolutely huge, especially hearing from where the money's already fled to. The money's fled to Microsoft, who could still continue to be doing okay. Apple, I'm a little bit iffy on that one. Meta, that's really going to be a big decider as well as we watch those earnings come out. And like I said, they come out within the coming weeks here. So we want to keep those on our calendar, on our radar. And you can also do that through the Moomoo app that you see here. All right, so I want to wrap this up. I do have to get going for the day. Transition, there we go. So if you guys like my commentary and want to hear more of it, check out the link for the Patreon down in the description. Click sign up. You get access to my Patreon exclusive content, as well as access to my private Discord with me and my community members where you can interact with us. We'd absolutely love to have you over there. And also don't forget about that Moomoo link that's down in the description. Get your free stocks and get a wonderful trading app that can help take your trading and investing game to the next level. Thank you guys for watching this video. Like, subscribe, and ring that notification bell to see anytime that my videos come out. I am Dr. Stock, Doctor of Education. We'll see you in the next video.